Gentlemen, a lot of investors in 2026 are staring at a market that feels quite expensive and asking the same question. Where exactly are the bargains hiding? The truth is, value hasn't disappeared. It's just been pushed into unloved corners where the headlines are negative, sentiment is bad, and the market is pricing in a worst case future. And that's exactly where undervalued opportunities come from. So today I'm going to give you 5 stocks that are extremely undervalued for 2026 and poised for exponential recovery. These are not meme names. These are real businesses with real cash flow, real assets, and clear reasons the market got bearish. Let's cut to the chase, starting from number 5 to number 1 being the most undervalued stock. Stock number 5 is Comcast, ticker CMCSA. Comcast is easy to misunderstand because people hear cable and assume the business is dying. But Comcast is not just cable TV. It's a broadband and connectivity giant, plus NBC Universal content, plus one of the strongest theme park businesses on earth through Universal. Seriously, guys, just pause and take a look at this empire built by Comcast. So why is it undervalued? Because the market is stuck on cord cutting and subscriber headlines. But the value case is that broadband is still the profit engine, and the company is quietly improving the parts of the business the market used to dismiss by integrating AI. And here's what that means. Comcast's AI strategy creates a massive competitive advantage by turning their existing infrastructure into an intelligent organism that is more reliable and efficient than standard fiber. By using AI for self-healing, automatically detecting and rerouting traffic during fiber cuts or power outages, they drastically reduce expensive manual repairs and technician truck rolls, which McKinsey notes can cut maintenance costs by 25%. Morningstar's fair value estimate is about $42 per share. With Comcast trading around $28, that's roughly a 30+% discount and a price to fair value ratio around 0.66 to 0.68. In the third quarter of 2025, Comcast generated about $4.9 billion of free cash flow and returned about $2.8 billion to shareholders through dividends and buybacks. Theme parks revenue rose to about $2,717 billion in that quarter, and theme parks adjusted EBITDA rose to about $958 million. Domestic broadband revenue was about $643 billion, and domestic wireless revenue grew to about $1.24 billion. You're also getting paid to wait. Comcast's quarterly dividend is 0.33 per share, which is roughly a 4.7% annual yield at these prices. And on smart money, Comcast is owned by the giants. Vanguard owns about 10%, BlackRock about 8.8%, and you also see serious long-term value managers like Capital Research and Dodge and Cox near the top. So the Comcast bull case is simple. The market is pricing the business like cord cutting kills everything, while broadband, parks, and improving streaming economics keep throwing off cash. If that gap closes even halfway, the upside is meaningful. Now, stock number 4 is Pfizer, ticker PFE. Pfizer is the classic post-pandemic hate trade. Investors looked at declining COVID revenue and decided the entire company was X-growth. That's why the stock retraced so hard. The market has been focused on what COVID took away and not focused enough on what Pfizer is building next. The company has a deep pipeline, especially in oncology, and it's actively buying growth where it makes strategic sense. Its oncology revenues already grew 7% in the first 9 months of 2025. Another recent example is Pfizer's re-entry into the obesity space through an acquisition deal reported around $10 billion, aimed at gaining access to a next-generation weight loss candidate that showed strong mid-stage results. Morningstar-linked value models in early 2026 have put Pfizer's fair value around $34. With Pfizer trading around $26, that's roughly low 30% upside potential if the market re-rates the business as the pipeline matures. Pfizer also pays you while you wait. The quarterly dividend is 0.43 per share. At today's price, that's roughly a 6 to 7% yield. Keep in mind, Pfizer is also dominated by institutions. Vanguard and BlackRock are the biggest names, and the stock is a core position across large index and dividend funds because of its scale and yield. The Pfizer bull case is that the market is treating Pfizer like a melting ice cube, while the pipeline and acquisitions rebuild the product portfolio, and you collect a large dividend while the re-rating happens. Stock number 3 is Albemarle, ticker ALB. Albemarle is one of the key global lithium suppliers. If you believe EVs, energy storage, and the electrification build-out are long-term realities, then lithium is not a trend. It's a supply chain. So why is Albemarle undervalued? Because lithium prices collapsed and the market punished everything in the space. The stock got priced like a permanently broken business, not a cyclical commodity leader. Morningstar has maintained a fair value estimate around $200 per share. With Albemarle trading around $163, that's roughly a 20 to 25% discount and a price to fair value ratio around 0.81. In January 2026, lithium carbonate futures surged about 30% in 1 month, and Albemarle stock jumped sharply as analysts started upgrading the name again. Albemarle also guided 2025 revenue toward the upper end of its range, around $4.9 to $5.2 billion. The company reported liquidity around $3.5 billion as of late 2025, including about $1.9 billion of cash and cash equivalents. On smart money, Albemarle is heavily owned by institutions. Vanguard is the largest holder, and you also see Capital Research, BlackRock, and State Street at the top of the list. The Albemarle bull case is straightforward. You're buying a bottom-of-cycle mentality. When lithium pricing normalizes later in the decade as demand rises and supply tightens, the equity often re-rates before the fundamentals look perfect. Now, stock number 2 is Occidental Petroleum, ticker OXY. OXY is one of the cheapest serious energy names when you look at valuation versus long-term cash flow potential. It has been held back by lower short-term oil price expectations and the market's fear that energy is a trade, not an investment. Morningstar has put fair value around $64 per share. With OXY trading around $43, you're looking at roughly a 1/3 discount. Occidental also has a very real shareholder in the room, Berkshire Hathaway. Berkshire disclosed ownership of roughly 348.9 million shares, around 32.7% of the company. OXY has also been actively managing its balance sheet. After the Crown Rock acquisition, it announced deals to divest certain upstream assets for about $1.2 billion, with proceeds intended for debt reduction. OXY forecast 2026 capex of about $6.3 to $6.7 billion, down from 2025 levels, while expecting flat to slightly higher production. OXY also pays a dividend, with recent declarations around 0.24 per quarter, which is roughly a 2.25% yield at current prices. The OXY bull case is that you're buying a high-quality energy operator at a discount, with Buffett as the anchor owner, and with a business model that can still generate strong free cash flow if oil stays only moderate. Before we get to number 1, I want to give you 2 quick honorable mentions that didn't make the main list, but absolutely deserve to be on your radar for 2026. The first is Adobe, ticker ADB. Adobe is the backbone software for the creator economy and digital content workflows. Photoshop, Illustrator, Premiere, Acrobat, these are not nice-to-have tools for professionals. They are still and will continue to be the industry standard. The market has been nervous about AI disrupting creative software, and that fear has pressured the stock. But the bull case is that Adobe is not being disrupted by AI. It's integrating AI. With Firefly and AI-assisted workflows embedded directly into Creative Cloud, Adobe is trying to turn AI into a feature that increases productivity and keeps professionals locked into the ecosystem. In other words, if AI makes content creation explode, the platform that owns the workflow can still win. The second honorable mention is PayPal, ticker PYPL. PayPal has been left for dead because investors assume it's getting crushed by Apple Pay, fintech apps, and buy now, pay later. The stock reflects years of skepticism about growth, but the bull case is that PayPal still sits on massive payment volume and a global checkout network, and management has been refocusing on profitable growth, pricing discipline, and improving branded checkout. If the company executes, the upside is not about becoming a hype stock again. It's about re-rating from declining relic to durable payments compounder. Now let's get to stock number 1. Stock number 1 is UnitedHealth Group, ticker UNH. UnitedHealth is the market leader in managed care, and it has a second engine that makes it more than an insurance business, Optum. Optum is a healthcare services and pharmacy benefit platform that gives UnitedHealth a diversified model, not just a single line insurer. So, why is it undervalued in 2026? Because UNH has been hit by regulatory scrutiny, investor anxiety over rising medical costs, and broader concerns about the healthcare reimbursement environment. The market is treating it like the business is permanently broken. Morningstar raised its fair value estimate to about $427 per share. With UNH trading around $331, that implies roughly 29% upside if the stock simply reverts closer to fair value. In the third quarter of 2025, UnitedHealth reported a medical loss ratio around 89.9%, which was in line with expectations, and it delivered adjusted earnings per share above estimates. Optum Rx revenue grew to about $39.7 billion, and here's the smart money signal that matters. Berkshire Hathaway disclosed ownership of about 5.04 million shares of UNH, valued around $1.74 billion. UNH also pays a real dividend. The quarterly dividend is $2.21 per share, which is about $8.84 annualized, roughly a 2.6 to 2.7% yield at today's price. The UNH bull case is the classic compounder setup. You're buying a dominant leader during a rare sentiment reset. If cost trends normalize, regulatory noise fades, and Optum continues compounding, the valuation can recover without needing heroic assumptions. Now, quick reality check. These five are undervalued for reasons. Comcast must stabilize broadband losses and keep improving streaming economics. Pfizer must prove the post-COVID portfolio can grow. Albemarle depends on lithium's cycle. Occidental depends on oil and capital discipline. UnitedHealth depends on cost control and execution. But that's exactly what makes them undervalued. The market is pricing in too much pessimism. Thank you for watching, and let's grow wealth together. Drop a like and subscribe. Let me know your thoughts in the comment section below.